Why smart money traders must always trust higher time frames. Most traders don't fail because they lack tools. They fail because they lack context. They know what a fair value gap is. They know what a break of structure looks like. They can mark liquidity highs and lows. They can even execute clean entries on the 1-minute chart. And yet, month after month, their equity curve bleeds. Not because their execution is bad, but because their direction is wrong. And today, we're going to talk about the one rule smart money traders never violate. Higher time frames are law, not suggestions, not filters, not something you check after the setup. They are non-negotiable authority. If you trade smart money concepts and you don't fully understand this video will change how you see the market forever. Section 1. SMC is not patterns. Smart money concepts is not a collection of patterns. It is not fair value gaps. It is not liquidity sweeps. It is not entries. SMC is a top-down framework. And within that framework, higher time frames decide everything that matters. Lower time frames do not create direction. They express it. Precision without direction is chaos. And the market does not reward accuracy. It rewards alignment. Section 2. The illusion of control on lower time frames. Lower time frames give traders a dangerous illusion. The illusion of control. More candles, more movement, more signals. You feel involved. You feel active. You feel like you're doing something. But activity is not edge. The 1-minute chart does not create structure. It reacts to structure. The 5-minute chart does not decide trend. It expresses trend. The 15-minute chart does not control liquidity. It delivers liquidity. All real decisions, trend, expansion, premium and discount, accumulation and distribution, are made above these time frames. Lower time frames are messengers, not decision makers. When traders ignore higher time frames, they listen to noise and call it information. Section 3. How smart money actually operates. Institutions do not trade the 1-minute chart. They don't chase 5-minute breaks. They don't care about your 15-minute entry model. They operate on scale. Their positions are built over hours, days, and weeks. Their objectives are measured in sessions and cycles, not candles. They use higher time frames to define the market narrative, identify accumulation and distribution, engineer liquidity runs, position inventory, control volatility. Lower time frames are used for execution efficiency only. Retail traders invert this process. They analyze low, then hope high aligns, and then they wonder why they are always on the wrong side of the move. Section 4. Higher time frames define market truth. Here's a harsh truth. Price can lie on lower time frames. Price cannot lie on higher time frames. Why? Because higher time frames compress noise. They filter randomness. They remove emotional fluctuations. They reveal intent. A 1-minute liquidity sweep can look convincing. A 15-minute displacement can look aggressive. But if the daily structure is bearish, those moves are not reversals. They are retracements. This is why traders who ignore higher time frames constantly fight trends. They mistake internal delivery for external change. Section 5. Structure is hierarchical. Market structure is not flat. It is hierarchical. Weekly structure governs daily behavior. Daily structure governs 4-hour behavior. 4-hour structure governs intraday delivery. When a lower time frame breaks against a higher time frame, it is usually a pullback, a stop hunt, a mitigation phase, a liquidity redistribution, not a trend change. True trend shifts always begin above. Smart money respects this hierarchy. Retail traders try to flip it, and they get punished for it. Section 6. Fair value gaps are not equal. Not all fair value gaps matter equally. A 1-minute FVG is a reaction. A 15-minute FVG is a delivery mechanism. A 4-hour FVG is institutional intent. The higher the time frame, the more weight the imbalance carries. Lower time frame FVGs exist because higher time frame imbalances exist. This is critical. If price ignores your lower time frame FVG, it's not disrespecting SMC. It's respecting hierarchy. Section 7. Liquidity is engineered top-down. Liquidity does not randomly appear. It is planned. Higher time frames identify where liquidity must be collected. Lower time frames perform the collection. 1-minute stop hunts are not spontaneous. They are scheduled outcomes of higher time frame objectives. If you don't know, where higher time frame buy-side liquidity rests, where higher time frame sell-side liquidity rests, whether price is in premium or discount on higher time frames, then lower time frame liquidity concepts become traps. You're trading execution without understanding the mission. Section 8. Why most SMC traders lose confidence. Loss of confidence is not emotional weakness. It is structural confusion. Traders lose confidence when trades look perfect but fail, entries are precise but direction is wrong, models work sometimes and fail randomly. That randomness disappears when higher time frames are respected. Consistency does not come from better entries. It comes from better filtering. Higher time frames eliminate bad trades before execution even begins. Section 9. Premium and discount only matter up high. Premium and discount are meaningless without time frame context. A discount on the 1-minute chart can still be premium on the daily chart. This is where traders get trapped buying discount inside higher time frame premium. Smart money sells premium on higher time frames and distributes on lower time frames. Retail buys discount on lower time frames and becomes exit liquidity. The market is not unfair. It is precise. Section 10. Time frame alignment is probability. When time frames align, probability expands. When time frames conflict, probability collapses. A trade with weekly bias, daily structure, 4-hour point of interest, 15-minute confirmation is not just a setup. It's stacked probability. You're no longer guessing. You're participating in planned delivery. Section 11. Lower time frames are for entry only. Bias is decided above. Execution is refined below. This separation is non-negotiable. If you decide bias on the 5-minute chart, you are already late or wrong. Lower time frames are tools, not authorities. Section 12. Patience is a higher time frame skill. Higher time frame traders are patient because they must be. They wait for meaningful levels. They allow accumulation to form. They let liquidity build. Lower time frame traders feel pressure to act. But trading rewards restraint, not urgency. The best SMC traders trade less, not more. Section 13. Why high time frame traders look effortless. They are not smarter. They are not faster. They are not more talented. They are aligned. They let price come to them. They don't chase. They don't force trades. Their confidence comes from preparation, not hope. Section 14. SMC is a framework, not a shortcut. SMC is not a shortcut to precision. It's a framework for understanding how large money moves price over time. And time is embedded in time frames. Ignore higher time frames, and SMC collapses into pattern trading. Section 15. Higher time frames reduce overtrading. Higher time frames reduce noise. Noise creates false opportunity. False opportunity creates overtrading. When you anchor to higher time frames, fewer setups qualify. This is not a flaw. It's the edge. Quality replaces quantity. Section 16. Market cycles live on higher time frames. Accumulation, manipulation, distribution. These cycles do not exist on 1-minute charts. They unfold over sessions, days, and weeks. Lower time frames reveal fragments. Higher time frames reveal the story. Section 17. You cannot outsmart the hierarchy. No model overrides time frame authority. You might win occasionally against it. You will never win consistently against it. Markets reward obedience to structure. Section 18. The professional mindset shift. Professionals ask, where is price relative to higher time frame structure? What liquidity has been taken? What liquidity remains? What phase are we in? Amateurs ask, can I get in now? Did it break structure? Is this an entry? Different questions create different outcomes. Final, closing statement. The market is not random, but it is hierarchical, and hierarchy demands respect. If you want to trade like smart money, you must think like smart money. And smart money always starts from the top. Lower time frames are where trades are placed. Higher time frames are where trades are decided. Ignore this, and you will always feel late, confused, and inconsistent. Respect it, and the market will finally make sense.